pain me. I had known that in my head, but let me make a list. It's good to take notes on this stuff too. I've been trying to be better about that. As you can see, I try to track so much stuff that I lose track of everything. So I try to take more notes. But if when you're doing the work, you're really dialed into it, you tend to retain a lot of stuff too. That's why it's so important to actually do stuff, not just read about stuff, but to take action. You pay much more attention when you actually pull the trigger on something, when you actually lose money. It hurts financially, but it hurts, like, especially when you're really dialed into something that works against you. Like, you're pissed about it, right? Like, what did I get wrong? What did I miss? And especially now, I feel I kind of a little bit frustrated. There's like 5 positions, and now this is one of them that I would call in March and April. This is the thing, and I think I said this in the other stream that I'm just so diversified. I was dealing in so many stocks. I don't hold it against myself too much. It's fine. It's no big deal. I missed Michael's. I got a 5-bagger on something else, but maybe I only got a 2-bagger on something else instead of Michael's. That's the thing. I had so many stocks that it's perfectly fine. There's great reasons in my own head as to why I may have missed something. It's not a big deal. It's more educational. It's like, what was it that I thought at the time? What was I thinking at that time that threw me for a loop? And if you have diligent notes, or if you don't, I was gonna do that in the stream. Or what's that program called? Evernote or something where we take the notes. Should I do that right now? All right, I'll make a note to myself. Maybe I should do that. Yeah, that's a good idea. I had downloaded, I think it's called Evernote, and I was going to take the notes right here on screen, right? I mean, you see me taking a note on a notebook. I like to have the notebook, but I seem like it would be better if it's up on the screen. So I think I'll do that. I'll try to do that for the next stream. So we'll make a note right on the screen. But what I would say here is that I was tracking Michael's even before all this happened. I did know they were generating legitimate free cash flow. Yeah, and I keep talking about it, but let me just heavily leveraged, and some other things too that it's been a while since I looked at it. And so I didn't totally miss it, right? I mean, it's in the damn portfolio. So so this is what I'm getting at here. Is it going to come up while I'm talking? That'd be nice. Let's see how long this takes while I'm talking. I tried to speed this damn spreadsheet up. Any chance it can happen quickly? Oh, that's not bad. Yes. That's not bad. What's that, 15 seconds? 20 seconds? 30 seconds. Definitely faster than 30 seconds. That's great. This is why I added the checkboxes, because I want to check it when I'm looking in the tracker spreadsheet. I don't want to have to open up the other spreadsheet, type it in, wait 30 seconds, wait a minute, probably what it used to be. But even if I have to type in the ticker, that's not too bad. And so look at it. So legitimate. So I'd say it was kind of similar to GameStop in this regard. This is a sizable retailer, $5 billion in revenues, and in fairly surprisingly stable. It's kind of fallen off, but not much. This is fairly stable in my view. Gross margin was kind of tailing off. Look at this gross margin trend. I need to clean this up. What is going on here? Let me see gross margin again. So this was that's a little concerning, right? From 40% in 2018 down to 35% as compared to GameStop, which was up, right? And this is the thing, everything's relative, right? There's no this stock is that's a thing. But when you're trying to manage the portfolio, it's all about relativity, where is this position cheaper on a risk-adjusted basis, as they say, than some other stock in the portfolio. And I remember thinking, because they was a little bit similar to GameStop, is that no, I'd rather have GameStop in the portfolio than this. And I mean, there's a case to be made that should have been more better dialed into Michael's, because it fell down. So of course GameStop didn't go down as low on the downside, but now it's bounced back so hard that if I had I don't know, whatever, just something I was looking at. The gross margin probably got my attention, and then the negative tangible. Look at this. It's got negative tangible book value. This is where it starts to get tough. Look at these levered figures, and then when you adjust using that calculator that I have. For those who maybe know, this is just a quick calculator on the top right over there. Hey, check this. Oh, watch this. I got a button here that. Oh, did it? Oh, I have a thing that I can highlight what's on the screen. It looks like it might have. I downloaded it, but it looks like it's not up on the top of my screen. All right, I got to look into that. Screen highlighter, whatever it is. But this top right, it adjusts the shares based on the amount of debt outstanding. Because it says this company's so levered that it's probably it might have to issue It might have to dilute the shareholder. So let's just do it now. And then what's the book like? What's the book value look like then? What does the free cash flow per share look like then with this new adjusted share count? And when a company's super levered, like Michael's was, it didn't make me comfortable using the prevailing share count, unlike GameStop, which it was far less levered than it appeared. So this is probably far less levered than it appeared too because of leases. A lot of the brick and mortar, the data of my spreadsheets is screwy because it's classified as debt. It sucks. And so it's not this levered as it appears. Anyway, if we look at the cash flow down here, at least on an unadjusted basis, it was generated simple free cash flow, operating cash flow less capex, just as a simple estimate, a proxy for what bona fide free cash flow is. You're looking at $2 per share. $2 per share in the 12 months ending May 20th. $2 per share, and the price point was, I mean, now it's $8. $2 per share on an $8 share price, so it's 4 times free cash flow, 25% free cash flow. Yeah, but it was less than 1 in March, because I think I saw it was trading below 2, right? God, but it was so levered that I'm like, well, that's great. It looks cheap, right? This is why you always need to dig into the stuff, and you can't just go on metric, blah blah blah. And so when I adjusted, I'm like, it doesn't look as appealing when you kind of adjust for the debt, and it just. It's like still appealing, but it's much riskier. It's a much riskier play because of that debt, because it could have. I'm kind of surprised about that. I remember thinking too, this was in March, like I don't know if they got to close their stores, and it was so important that the stores be open, right? I don't even know. Maybe they do have a solid online presence. I'm actually not sure. But and then when I thought, all right, they could be in trouble, but solid free cash flow, good sized company. No one was any insider buying. This is going to piss me off if insiders are buying. Then this is okay. At least that no insiders are buying. And then who owns it? I think some PE firms are involved. Well, Wisdom, good website for checking ownership. Just a quick check on ownership. Oh, we're gonna get new holdings next week for Bain. I did know Bain. They own like 35%, and then I had questions. So I don't know who owns the debt, but if Bain owns the debt too, then date last reported. Yeah, so Bain owns a good chunk of it. On the one hand, I don't know. That could be a good thing because Bain doesn't want it to go bankrupt, right? And they own 35%. Damn, that's actually a good chunk. That could have been a risk mitigator for me. A company can still go bankrupt in this situation. It's not to say that that company can't go bankrupt. See what I mean? There's other ways to adjust for risk, and if you know who owns the company, and who has a big chunk, and then there's clearly a backstory here with Michael's, which I had read about back in the day. But if a PE firm owns 35%, either they took you public, or if I do this is where Seeking Alpha would be helpful, because someone has certainly written a report on this. This is a pretty classic value stock. Calling it undervalued in June, but that was in June. January, I probably read that one. Oh, I probably read Vince Martin's. Was there one in? Sorry, I'm just want to check. I probably read Vince's. October, maybe? Did someone else talk about Michael's too? Outside of Seeking Alpha? Josh Arnold? I'm not going to read it now, but can I do it quickly? Did some see if there's a super thorough thesis, not that if you're writing a report it should be super thorough, but if it's super thorough, they're going to mention a little bit of background on the stock, like why the firm's involved with it. All right, you know what I could just do? Bain. Okay, Bain's not there. Bain. Okay, no Bain. How do you not mention Bain? How do you not mention Bain in a report? That's what's a little bit surprising. Okay. All right, so here's the other thing. Okay, so the bonds, these are bonds for 2027, so those are pretty far out. Those are that's far out. It's not 20 years, it's not 100 years like some people talk about issuing bonds for. But 7 years out for a company like this, heavily levered, brick and mortar, that's the distant future. And its bonds, this is it. The bonds only got down to 60. That's not that cheap. Like I would have thought that. And they probably figured this is the thing with a company that's generating a ton of free cash flow, and it looks like maybe it'll stick around. The bonds are probably safe. That's what I mean. It's not always hand in hand where if the company's going bankrupt that the bonds are going to trade in the 20s. It depends on where they are in the totem pole and so forth. There's a lot of other factors at play. This is just a quick rule of thumb. And for these are probably the most senior. I don't know if they have other debt too. Probably the most senior debt that they have, and they probably would have been fine. That's why it never got into the 20s. So that's just something to bear in mind, that the seniority of the debt matters. Nevertheless, as a quick rule of thumb, only trading into the 60s, that's indicative to me that it probably isn't going bankrupt. I mean, that's a sign of distress, 60s, don't get me wrong, but for someone like me, I'm not concerned with 60s. I see 60s, I'm excited because I think stock price is probably sold off. People are getting nervous, and I step in and I'll take the risk because a good chunk of them don't go bankrupt and they go 3x, 4x, 5x. It covers your losers. That's how it works. It's as simple as that. So for whatever reason, I didn't go heavy into Michael's because I was buying other stuff, and I thought so much debt. I had plenty of other retailers too. I didn't need more retail exposure. And then I changed my mind. I don't know when. I don't remember off the top of my head when I changed my mind, but I probably changed my mind. I want to say it was right around May. This because I probably wouldn't be. This happened so quickly. I doubt I was. I don't like to buy on the uptrends. It makes me. You can. But it pisses me off. So I might wait for a pullback. But I bet I bought right here, and I thought, damn, I messed up. I probably did what I'm doing right now. Checked out the bonds. Read up on the story if there was a seeking alpha. Oh, this was before the June article. But probably reassessed the story and was like, all right, I made a mistake. Maybe I sold out some other positions, and then I bought back in. It's okay not to buy at the bottom, right? No problem. And I bought back in, and now it's a 0.4 position. Not a huge position, but that was I distinctly remember being, damn, I made a mistake. It still looks cheap. If they're not going bankrupt, they're probably still cheap. It probably could be at least a double, triple, four bagger maybe, but still a lot of risk. But if I didn't buy it, it was because of bankruptcy risk. And then when I looked at how it was unfolding and took another sober look at the data, I thought this setup looks good, and bought it. So, all right, that's good to know. There was a couple other companies like that. I mentioned them last time too, but cool. And that was up 5% today. Did they report? It doesn't matter. I'm less concerned with that one. Such a small position. Just curious. No. Agile Therapeutics. Okay. Owens and my. Excuse me. So what happened? Okay. That was up big. Now it's giving back some of its losses, but this one still looks kind of interesting. It's no longer super cheap, but okay. Let me. They just reported, didn't they? That was why it skyrocketed. You know someone who's invested in this is Vince Martin's got an article on that, but Bloom on Seeking Alpha. He's a good author too. I think he said he was a credit analyst, and his reports, solid reports. I think he was bullish on it. Let's see if he commented. Jeremy, no, really, no, okay. Sorry, I'm scrolling so quickly. They did look like a sign of risk at bank history, but I don't want to read this article right now. I just checking real quick because was that the most recent